I'm Charlotte McLeod with investingnews.com, and here today with me is Edward Sterck, Director of Research at the World Platinum Investment Council. Thank you so much for being here. Great to have you as always.
Oh, Charlotte, thank you for inviting me on. It's always great to chat.
Of course, really good to be catching up with you. And of course, as usual, we'll be talking about the World Platinum Investment Council's latest quarterly report. This one gives us a look back at the full 2025 year, and the deficit for the market ended up being over 1 million ounces, which is larger than initially projected. So I thought we could start with a look back at last year and why that deficit ended up coming in higher.
No, it's a good question, and it's worth unpacking because there's some interesting takeaways from the changes that we can probably reflect upon, particularly when it comes to the outlook for 2026 as well. So our last quarterly update was published in November. The big fundamental change from the roughly 750,000 ounce deficit we were forecasting then to the slightly more than 1 million ounce deficit we're forecasting now principally comes down to investment. So in essence, there are three areas of investment where we saw quite considerable relative strength in the fourth quarter. Firstly, borrowing coin demand continued to be extremely strong, particularly out of China. But then we also saw exchange stocks, which are the physical warehouse inventories that back positioning in futures markets, such as the CME. We were expecting some unwinding of those exchange stocks going into the end of the year. And in fact, they've ended up remaining higher for longer, and that's a theme that is likely to continue through this year as well. And then we were also expecting previously some ETF profit taking on the back of higher prices. And in fact, we saw the opposite. We saw incremental demand for ETFs in the fourth quarter that accelerated into the year end. So those changes together in principle drove the change in that deficit to deeper levels than we were anticipating before. It's probably worth also me just giving some context. What is a deficit of over 1 million ounces? Well, the total market in terms of demand is about 7.8 million ounces. So you can see it's quite meaningful in terms of the shortfall of supply relative to that demand level.
Well, and I believe, is this the largest deficit in terms of how long the WPIC has been tracking the platinum market?
It is, yes. So we were set up in 2014 rather. Our time series goes back to 2013, and it's the biggest annual deficit in that time series at the moment.
Yeah. So definitely worth noting. And we'll take a look at which of these dynamics you see continuing into 2026. But before we do, I thought it's worth mentioning the price activity we've seen in platinum just over the last year and especially the last couple of months. So after years of range-bound trading, it started breaking out in 2025 and especially into December and January. I wonder, were you expecting to see that large of a price move that quickly?
Well, I mean, I think, if we cast our minds back to this time last year or even, the sort of end of April last year, really, actually the question was, well, why hasn't the price moved? We were at that point in our third year of forecast annual deficits after 2 confirmed years. And yet, as you said, the price had remained range bound. And I think really what we were anticipating was that the tension that was building in the market, we could see lease rates that had been going up consistently since roughly the end of November, beginning of December the prior year. And we had strong OTC backwardation in the London market. Those are indications that there's tightness in the market. And we were expecting that to translate into price action at some point. I think it'd be fair to say that when price began to move in May, that probably validated that perspective. But at the same time, and we don't forecast price levels, we just try to give an interpretation of what market conditions should do in terms of translating into value expectations. But it's probably fair to say that the scale of the price move and the pace at which it moved was, quite surprising. At the end of the day, only from a beginning in May, platinum ended up 2025 with the price up 127%. Then going into 2026, we saw a further acceleration of that. And then prices pulled back quite sharply. We've seen a kind of stabilization, a consolidation phase, if you like, at pricing somewhere between $2,100 and say $2,400 an ounce. So still up quite considerably from last year, and it's probably a fairly healthy period of price consolidation. What was behind that? Well, we've got the strong underlying fundamentals for platinum overall, but it's probably worth noting as well that from a macro-political, macroeconomic landscape, there was a high degree of uncertainty coming through the second half of last year. That continued into 2026. And so to a degree, that's translated into increased investment interest in the precious metal complex as a whole. You can see that in the price of gold and the price of silver and some of the trading activities that occurred around those metals. And platinum, was a mutual beneficiary of that sort of trend.
Yes, definitely we can see that activity throughout the precious metals complex. And good point, although the platinum price did move quite quickly, we were waiting to see that for a number of years. So if we look forward to 2026, there's another deficit projected, although a smaller one than in 2025. I wondered if you could talk about whether you see that coming more from the supply or demand side, that deficit that's coming this year.
Well, supply is for the most part pretty much price inelastic. So we've got higher prices. Normally you'd expect one way to solve for a supply-demand shortfall is for higher prices to either incentivize new supply into the market or to disincentivize demand. And with platinum, particularly at the mining level, because these are typically deep-level underground mines, they're polymetallic mines as well, producing all of the PGMs plus gold and some base metals as well. The economics of the mines don't depend just upon one metal. And so making planning decisions to increase, let's say, output in response to higher pricing for one commodity is very, very difficult. That said, all of the commodities have kind of gone up a fair degree, and that's very supportive of mine economics. But going back to the concept, these are deep level underground mines. Intrinsically, it's just very difficult to flex output quickly. And so these are long-term decisions, and mining companies typically take quite a long time to consider making long-term investments. I mean, to give you one example, we've got one new mine in our numbers this year, and they started construction of that almost 10 years ago. So that's the kind of time frame we're talking about here. We do see more price elasticity when it comes to recycling supply. So in our numbers, we've got a 10% year-on-year increase in recycling supply, and that's mainly driven by higher automotive and higher jewelry recycling rates. But on the demand side, actually demand for automotive applications is largely flat year-on-year, down very modestly given ongoing electrification. Jewelry demand is pulling back a bit from 2025, and that's largely due to 2025 numbers being boosted by a really strong second quarter of last year in China. In terms of industrial demand, a bit of a recovery from cyclical lows last year where we had fewer glass capacity additions. But the big change again, year on year, or versus our last update, is investment demand. So we've got quite a significant 46% year on year decline in investment demand in our numbers. That's resulting in the smaller deficit. And that's a big figure in terms of a headline, but it masks actually a nuance, which is that investment demand is still extremely robust. So last year's figure was boosted by significant ETF additions. This year, we're expecting neither additions nor disposals. So effectively, ETF levels to remain flat at what are actually pretty elevated and healthy ETF holdings. And then in terms of exchange stocks, previously we were forecasting exchange stock outflows. We're now expecting only very modest outflows on an anticipation we see some easing of trade tensions, and that can allow for metal to flow out of those futures exchange warehouses. But again, actually, that's still staying much higher than we were previously anticipating. So whilst the headline figure, just to reiterate, whilst the headline figure is for quite significantly less incremental new investment demand this year, actually it's still a very robust investment demand environment.
Yeah, I thought that was an interesting nuance there. So thank you for going into that one. And what about the bar and coin investment demand? How is that looking in 2026?
Actually pretty strong still. So we're still expecting strong continued growth out of China, which has been the main market for growth over the last few years. But we are expecting a bit of a rebound in the US. So demand in the US in 2025 was suppressed by effectively a shortage of product availability. You've got high lease rates. A lot of the fabricators of investment bars and coins would typically lease metal for the production process so that they aren't exposed to market price fluctuations. The elevated lease rates have made that very expensive for them. And so they just manufactured less product. Ironically, we saw strong investor demand for bar and coin in China, in the US last year, but they just couldn't find the product. And we are expecting that situation to ease a bit this year. Together with, there were some trade barriers to importing bar and coin into the US last year that have now been solved. And so, just a little bit of a stronger market in North America as well.
Yeah, that's an interesting point to note as well. And another nuance I wanted to pull out from the report, it notes that there is a factor that could influence a higher deficit in 2026, which is exchange stocks at the Guangzhou Futures Exchange in China. So I wondered if you could go into that.
Yeah, so it's an interesting new part of the market that we haven't yet captured in our supply-demand balances. So as I've already, already talked about quite a lot, our investment demand includes movements of those exchange stocks, warehoused inventory, if you like. That's the physical metal used to back futures positions on the different exchanges. The CME is the biggest one in the West. You've also got the Osaka Securities Exchange in Japan. And now we've got a new one in China, the Guangzhou Futures Exchange, which launched in November last year. Now, their first contract has got a June expiry, so that's quite a long lead time to that. As time goes on, anyone holding short positions on the GFEX will need to collateralize those positions with exchange stocks, and we will gradually capture that level of incremental exchange stock build as the data becomes available. At the moment, we don't have a good estimate of what that would be, but it would be incremental to our investment demand, and ultimately could help deepen the supply-demand deficit based upon our current outlook.
So that will be a point to keep an eye on moving forward. And I wondered if there's anything else that you would add on China's growing role in platinum demand, because it sounds like something that continues to develop.
Well, China's been the biggest consumer of platinum and PGMs globally for a number of years. I think where it's becoming more and more impactful is not so much on necessarily just on the demand side of the equation, where clearly as the biggest producer, it has been impactful. But a lot of value establishment occurs in the secondary market in terms of derivatives trading, in terms of the recirculation of metal, lease markets, and so on. And because of the structure that China has in terms of its domestic market, it hasn't been as impactful in those areas as it probably should be as the biggest consumer. So I think with things like the GFEX launching and the fact that that's going to be open to international participation in due course, and that obviously creates arbitrage opportunities between the different exchanges. In a way, China, despite being the biggest consumer, has been sort of a price taker in the past. Whereas now, as a nation, it's going to have much greater impact on value establishment in international markets.
That seems to be, again, another theme that follows across the precious metals market. And one point I wanted to bring up is growing tensions in the Middle East and how that could impact platinum. Definitely for gold and silver, there's that element of safe haven demand that can come into play. For other commodities, it can influence trade flows. And I'm not quite sure how it pans out for platinum. So I know it's very uncertain times, but is there anything you can point to in that regard?
Well, I think platinum, follows the same path as gold and silver, as we saw through that December, January period this year, where it is a safe haven investment. In a way, if you look at just that part of this, with regards to gold, silver, and platinum, it's been a bit surprising not to see greater strength in those markets, just given the uncertainties and to a degree the inflationary factors that we see coming through from higher oil prices and so on. That said, I think if you look at the dollar activity, it seems like the markets are pricing in fewer interest rate cuts because of higher inflation concerns in the US, and so therefore a stronger dollar. And that's negative for commodity prices in general. And maybe there's an argument to be said that even though the US is one of the protagonists in this uncertainty, actually the dollar safe haven trade is still kind of in play here, versus everyone looking at the precious metals last year and earlier this year. I think, however, if we look at the economic environment, nothing much has necessarily changed in the US. We saw some pretty poor non-farm payrolls last week, and so the argument for a pivot to hard assets, including precious metals, is probably one that's still there. And I think will remain there through the course of this year. However, just taking the conflict in terms of the impact of trade flows, the Middle East, while not a major producer or consumer, well, they're not a producer of PGMs, but they're not a major consumer of PGMs. A number of those countries have become quite important conduits for commodities trading, and including the PGMs. So there's a possibility we see some short-term disruptions just to the movement of metal, more than anything else. Of course, on the demand side, oil does have an impact. So a portion of our industrial demand profile is attributed to petroleum refining and so on. So it's catalysts that are being used in those refineries. If those are not being utilized to their full extent because of less oil availability or higher and uncompetitive oil prices, that could have a small incremental negative in terms of demand for platinum. But I'd say it's probably more likely to fall into next year than this year. So it's probably more of a 2027 story.
It's a definitely evolving situation, so we'll see how it plays out. I'm sure we'll talk about it again in the future. I wonder, are there any other more global factors that you are watching heading into 2026 for the platinum market that we didn't cover yet?
I suppose one of the major things really is just the trade tensions in the US that emerged last year with tariffs and various investigations and so on. And the two ones I'd highlight here are the Section 232 investigation into critical minerals, which includes the PGMs, and the US ITC investigation into alleged dumping of Russian origin palladium. Now, both those processes are still ongoing and have quite significant bearings on how sticky metal that's been proactively onshored into the US remains stuck in the US, or whether it would be made available to the international markets, perhaps the leasing market back in London, and whether that metal would help ease some of the market tightness we're seeing at the moment. So those investigations are quite key. Really, the timeline for this is kind of going into the first part of H2. So we're looking at greater kind of data discovery as we probably go through the course of the second quarter, and then potentially much greater certainty in H2. At the moment, if you look at things like those CME warehouse inventories, they every time we see a spike in lease rates, we see people trying to move metal out of the exchange because there's an incentive to do so. But they just keeps on kind of going back to previous levels on ongoing uncertainties. So I think that's something that's helping keep the market tightness. That said, it's worth just stressing that with the deficits that we've had over the last 3.5 years or so, you're looking at about a cumulative almost 4 million ounce deficit over those years. Fundamentally, releasing several hundreds of thousands of ounces from US inventories isn't enough to rebuild above the depletion, the above ground stocks that have been depleted over the course of those deficits.
It sounds like we're heading into quite an interesting year in 2026. So we'll talk throughout. But before I let you go, any thoughts you would add for investors right now? I know the WPIC isn't making price predictions or giving advice, but I think a lot of people are wondering, all right, is this the time to enter the market? What should we do? So any final thoughts there?
Look, I think, the kind of a lot of the themes that came out last year are going to persist through this year. So you've got the strong underlying supply-demand fundamentals. You've got the depletion of above-ground stocks that I just touched upon, which were still a balancing factor in the market, but down to unsustainably low levels. And just the shortage of those above-ground stocks is a major factor in the tightness that we see in the market. That's going to persist with another year of deficits. And then you've got the kind of macroeconomic uncertainty, which again, as we've seen just in the last week and a half or so, as we saw with the actions in Venezuela, that's going to persist this year as well. So I think it's pretty hard to kind of take a negative view to precious metals in general from where we stand. But given the strength in the price moves, I think it would probably be also to say, are we going to see those repeat this year? And that would be a harder thing to call. But overall, just to kind of reiterate, a lot of those themes behind the price rally last year are still in play this year and really arguably for the foreseeable future.
I think that is a great note to end on. So thank you so much for coming on to go over what you see coming for platinum. This was very helpful.
Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Edward Sterck with the World Platinum Investment Council.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.